Welcome to the deep dive. Today we're jumping into something that's, well, really making waves in finance. Stablecoins.
Uh-huh.
I mean, just recently we saw Paxton, a major stablecoin company, its stock just, boom, quadrupled in 3 days after its IPO.
Incredible, isn't it?
And it's not just the usual tech or crypto folks talking anymore. We've got huge names like Alibaba, Standard Chartered, even Hong Kong Electric thinking about issuing their own.
Yeah, it's definitely moving beyond niche. It feels like it's hitting the mainstream.
Exactly. So our mission today for this deep dive is really to unpack what these stablecoins actually are. Why this sudden surge? What are the real benefits?
And crucially, how safe are they? That's a big question. We'll also touch on some of those more interesting theories floating around about what they're really for.
Right. And before we dive right in, maybe just take think about it.
Yeah.
Have you come across stablecoins? Maybe use them without realizing.
So first things first, what exactly is a stablecoin?
Yeah, let's start there.
Unlike, say, Bitcoin, which we all know can be incredibly volatile, stablecoins are built differently. They're designed to hold a steady value.
Okay.
Usually they're pegged one-to-one with a regular currency, like most often the US dollar. So one stablecoin equals $1.
So it's not just that they're digital, it's the backing.
Yeah.
That's the key. Tell us about that collateral.
That's precisely it. For every single stablecoin that's out there, there has to be an equivalent value held in reserve, like real assets.
What kind of assets are we talking about?
Mostly cash, or things that are almost cash, like U.S. Treasury bonds, really short-term ones, or other highly liquid, very short-term debt.
Stuff that can be turned back into cash quickly if needed.
Exactly. Think debt that matures in just a few days or maybe weeks. It ensures the issuer can always meet redemptions.
That analogy makes sense. It's kind of like digitizing physical money.
Right.
You put $100 in the bank. You see $100 on your statement.
Uh-huh.
You give $100 for stable coins. You get 100 stable coins in your digital wallet tied to those actual dollars or assets somewhere.
Perfect analogy. And, this is really important when we think about past failures. Remember UST, Terra USD? That collapsed spectacularly a few years back.
Oh, yeah, that was messy.
Well, the crucial difference is UST wasn't backed by collateral like this.
Right.
These modern stablecoins, the ones gaining traction now, are fundamentally different because they are backed by real audited assets. That's the foundation for their stability.
Okay, so we understand the what. But the why now is fascinating. Why this sudden huge surge in interest and, well, actual use?
Yeah, that's a great question. A huge driver, honestly, has been shifts in policy and regulation. Things are changing fast.
How so?
Well, in the U.S., for instance, they passed the Genie Act. It basically creates a proper legal framework for stablecoins, provides some rules of the road.
And it's not just the U.S., is it? I heard Hong Kong, Korea.
That's right. Similar moves are happening elsewhere, either new laws passed or things in the works. It feels like governments and, the big financial players have realized this tech isn't just going away.
So instead of fighting it, they're looking to regulate it, maybe even use it, get some control.
Exactly. Shape how it evolves rather than letting it be a complete Wild West, but also harness the efficiency gains.
And the market's definitely noticing. You mentioned Paxton earlier. That IPO. Wow.
Yeah, the second biggest stablecoin company goes public. Stock jumps 4x in 3 days. That's significant.
And they're not small fry either, right? You said 40% market share?
Roughly 40%, yeah.
Yeah.
Market cap around $26 billion, and they've been profitable since 2023. That tells you there's real market traction, real confidence building.
Absolutely. But here's what really gets me. Okay, crypto people, finance people, fine. But when you see Alibaba, Standard Chartered Bank,
Yeah.
Hong Kong Electric, a utility company, getting into stablecoins, that feels different. What's in it for them?
Well, for them, it boils down to some really tangible benefits, especially for businesses. Think retailers like a Walmart or an Amazon. The big one is cost savings.
How much are we talking?
They could potentially save like 2-3% on transaction fees if people pay with stablecoins instead of credit cards.
Now, okay, 2-3% doesn't sound like a world-changing number, maybe.
But in retail, where margins are often razor thin,
Ah, right. It's actually huge then.
it's incredibly significant. It's not just pocket change. It could shift the economics a bit, maybe give merchants more power back from payment processors, maybe let them do new things with loyalty programs.
Interesting. And it's not just cost, is it? There's speed, too.
Oh yeah, much faster settlement. Credit cards can take, 1 to 3 days for the retailer to actually get the money?
Uh-huh.
With stablecoins, it can be minutes, maybe even seconds. That frees up cash flow, makes everything run smoother. It's a big deal.
And thinking bigger picture, What about people without bank accounts?
Yeah.
Billions of them globally.
Exactly. That's another massive potential impact. They often can't access basic financial services, right? No transfers, no simple borrowing or lending.
Yeah, locked out.
But with stablecoins, all you really need is a smartphone and internet. Suddenly, maybe they can access these things, send money easily, locally, or internationally. It could really change how global payments work, especially for the unbanked.
So cheaper, faster. What else?
Well, for anyone moving money across borders, it gets way cheaper. Think about sending money from, say, Hong Kong overseas. Bank fees can be like HKD 200, maybe more.
Easily.
Stablecoin transfer could be just a few dollars. And it's 247. Weekends, holidays, middle of the night, doesn't matter. Banks have hours. Stablecoins don't sleep.
Okay, sounds great for users, great for businesses. But what about the companies issuing them? Like Paxton. How do they make money? Is that model solid?
That's a fair question. And the model is actually surprisingly simple. It's very much like how a traditional bank operates.
How so?
You give them, say, $1,000 cash. They give you 1,000 stablecoins.
Okay.
Then the company takes that $1,000. They keep some as actual cash, ready for redemptions, but they invest a chunk of it.
Invest it where? Risky stuff.
No, that's key. They invest it in extremely safe short-term debt, like those U.S. Treasury bonds we mentioned. Very secure, very liquid stuff.
Ah, so they earn interest on those reserves. That's their profit. Like a bank earns interest on deposits.
Exactly like that. And the beauty is, once they cover their basic operating costs, it scales incredibly well because they're managing huge volumes of these reserves.
Okay.
It's definitely a volume game.
Which brings us right back to the safety question. If they're holding my dollar, how safe is it really? We talked about the backing, but what about regulations, protections?
Right, crucial point. That new legislation, like the U.S. Genie Act, is specifically designed to address this. It mandates that 100% asset backing. $1 held for every one stablecoin out there. That's the rule.
And rules about what they can hold.
Yes, very strict rules. Only the safest, most liquid assets. Cash or that super short-term, high-quality debt. No risky ventures allowed with those reserves.
And transparency. Audits.
Absolutely. They're required to get regular audits, often monthly, plus annual ones, to prove publicly that they actually hold the reserves they claim to hold. That oversight is vital for trust.
Okay, and what happens if, worst case, one of these companies goes bust? What happens to my stablecoins, my money?
That's another really important protection built into the new regs. If an issuer fails, the stablecoin holders get priority. They're first in line to get their money back ahead of other creditors.
That's a pretty significant safeguard.
It is. And think about those large companies getting involved, the Alibabas or Standard Chartereds. For them, the stablecoin operation is likely a tiny fraction of their overall business. Even if they decided to wind down the stablecoin part, they'd almost certainly have more than enough funds to pay back every single holder.
Okay, that builds confidence. But, with anything involving crypto or digital currencies, there are always theories, sometimes conspiracy theories.
Yes, always.
So what about this idea that the U.S. government is pushing stablecoins just to force companies to buy U.S. debt, help manage the massive national debt?
Right, I've heard that one. The argument is basically that by legalizing stablecoins, which have to hold safe assets, they're creating a captive market for U.S. Treasury bonds.
Sounds plausible on the surface, maybe?
Well, let's look at the scale. The entire stablecoin market right now is maybe $250 billion-ish.
Okay.
The U.S. national debt, it's over $30 trillion.
Right. Bit of a difference.
It's like 100, maybe 150 times larger. Even if every single dollar in stablecoin reserves was put into U.S. debt, which it isn't, they can hold cash too. It would be less than 1% of the total debt.
Not exactly moving the needle on $30 trillion.
Not even close. Plus, think about where that money is coming from. Often, it's moving from a traditional bank account to a stablecoin wallet. Well, banks already invest customer deposits, potentially in U.S. debt. So it's often just moving from the left hand to the right hand in terms of overall holdings. It's really a tiny drop in a huge ocean.
Okay, so that theory seems a bit thin when you look at the numbers.
Yeah.
What about the other one? That stablecoins are just a sneaky way to create a U.S. digital dollar, a CBDC.
Yeah, the idea that this is step one towards merging the dollar with some kind of government-run digital currency.
Is there anything to that?
Well, currently it seems pretty unfounded. Donald Trump actually signed something specifically banning the U.S. from issuing a central bank digital currency. So politically, that door seems closed for now.
Interesting.
Look, these theories are definitely attention-grabbing, right? But when you dig in, they don't seem to hold much logical water. The simplest explanation is usually the best.
Which is?
Stablecoins are basically a financial utility. They're tools designed to make payments easier, faster, cheaper, kind of like a sophisticated gift card or a payment network, not some grand government plot.
So wrapping up our deep dive then, it seems like stablecoins are moving fast from the fringes to become a, well, potentially reliable, widespread, and thanks to regulation, increasingly safe way to move value.
Yeah, the underlying tech, whether you call it blockchain or crypto or whatever, is almost becoming secondary. What matters is the practical use, the convenience, the security.
Which leaves us with a thought for you, our listener. As these stablecoins get more common, maybe as easy to use as, say, Venmo or Zelle or Payme is now.
Or Apple Pay, globally.
Right. How could that change your daily habits? Would you start using them instead of credit cards? Or for sending money? What does this really mean for the future of money? Not in your wallet, but on your phone.
Something to think about as this technology keeps evolving. It's definitely a space to watch.
Absolutely. Thanks for joining us on this deep dive.